Sylvia's Traders Lounge, in partnership with Scope Markets, welcome you to yet another webinar where we learn, trade, and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology. Today's guest is Raghee Horner, and our theme is Forex and Futures Trading Simplified.
Hello, everyone.
Yeah, we can see your screen.
Oh, you can see my screens. Oh, well, while you guys are here, I'll give you a quick tour of my office. So, oh, there it is. Oh, excellent. Go figure, the oldest camera in my office is getting along. So this is my layout. What you guys are seeing right now is where I sit every day and I trade. There you guys are.
Yeah.
And then this little quick look at my my bookcase over here. So welcome to my office. All right. Excellent. Excellent. Yes, the nickel tour. Okay, let me see if I can get this focused on me. Okay. And then we can get going. Oh, no, that's a picture my mother painted for me. Oh. She said that's the elephant, the mother elephant with its head against the tree because of the baby elephant.
You should visit Kenya to come and see the real elephants.
Oh, we would love that. Yes.
Right.
She loves taking photos. Okay, let's see if this will work here. Can I turn this over? Oh. All right. I think we're good.
Yeah, now we can see you.
Excellent. All right. So let me move this out of the way. So you guys ready to do some trading view?
Sure.
Okay. Excellent. Excellent. And again, welcome to my office. All right. So that back there, if you guys can see, my husband started trading with me. I don't know how many out there your significant others trade with you. My husband trades with me. That's his little rig over there. But you know, a lot of people say, do you need a million monitors? You really don't, because I trade so many markets and I also teach and I'm in different chat rooms and whatnot. The extra monitors are very helpful. I like to experiment with code and things like that. So for most people, I think 2 monitors is pretty important. You want one for your screen, one for your order execution or research. And 4 is probably where I think most of the traders that I teach, and they usually will end up in that kind of setup, but you certainly don't need it. When I'm on the road, I trade off my phone and a laptop, and a 13-inch laptop. So you certainly don't need anything like this. But all right, let's get started with our with our trading view. So normally I will get up, and a lot of folks also ask, when do I start my analysis? And I will typically start my analysis and my first of many cups of coffee around 4:30 a.m. Eastern. So at this point, it's almost 8 in the US, and I've been up for about 3.5 hours. So the reason for that, and let's think about time for a moment before we get to the charts. One of the things that I recommend is always know which financial centers you're trading. In other words, am I trading the end of the Asian session? Am I trading the lull between 4 a.m. and 7 before the US session really gets going? Or am I trading the most actively traded hours? And I'm going to show you that here today too, excuse me, using a program called AutoChartist. And we're going to talk about when those volatility times of day are. Not necessarily so you can start thinking strategy, stop losses, and entries, although you could. But one of the biggest mistakes I see a lot of traders make is not think about the volatility at a certain time of day. So I'll share that with you all as well, and I'll show you a site that I use for that. And depending on the broker you use, the volatility data that I'm going to talk about, they work with many brokers throughout the US, and that data is free. So I really chose a lot of free tools in my personal trading and the trading that I'm going to share with you all here. Okay, so we're looking at TradingView, yes? Right now?
Yeah.
Okay, excellent. Yeah. Excellent. So the first thing I'll do is I'll get this rig going in the morning, and I will usually log into my TradingView for stocks and Forex. I do not use this platform for futures. So in the upper left corner, you'll see sort of towards the middle, but there's a box that says indicators. So hopefully everybody can see that. indicators. So you'll see the symbol, there'll be some time frames. I believe there's a box that says compare, and then there'll be a little box that says indicators. And if you don't see that, you're not probably on the chart layout. So one of the things you'll have to do once you're, I'm assuming most of you, if you're actively using TradingView, you are on your chart layout. So we're going to add some indicators, and it's the indicator button you're going to click. Once you're there, you can search amongst the sea of indicators. So there are 3 indicators that I've made free. We don't have a lock on them. So you're going to search for Simpler, S-I-M-P-L-E-R, Simpler, S-I-M-P-L-E-R. And there'll be 3 indicators that come up that, amongst many, that do not have that little red lock around it. One is called the Simpler Trading Darvis box. One is called the Simpler Trading Grab Candles. And the last is the Simpler Trading Propulsion. We're good?
Yes.
Excellent, excellent. All right, those are the 3 that you can put on there. However, if you have the free version, what I'll recommend is you add, instead of the propulsion, there is another tool that someone out there just created, and it allows you to use all the different, and I'll explain what these indicators are in a moment, but look up just the word propulsion, P-R-O-P-U-L-S-I-O-N, propulsion. Just look up that word, and one of the indicators that will pop up is someone, I don't even know who they are, they created, they basically took the free indicator and they made it so that you can create multiple instances of propulsion without exceeding that 3 indicator limit on TradingView. And it's called propulsion dots for up to 7 EMA. So if you look up propulsion, one of the results, okay, excellent. So you can activate that. And I think that one's actually easier to use because you don't have to have 4 and 5 propulsion instances running. So you'll have the Darvis, the Simpler Trading Darvis, the Simpler Trading Wave and Grab, and that propulsion dots for up to 7. All right. So once you've got those running, let's talk about each one of those indicators and how important they are in my trading. And it doesn't matter if you're futures trading, stock trading, Forex trading, good systems in my approaches, whether you call them methodologies or systems, should really be 2 things. And I learned this from Charlie Wright, who very early on worked with TradeStation, and TradeStation's very much a system developer's platform. There's a lot that we can learn from systems traders. One is having strict criteria for not only your entries and exits, but having strict criteria for why certain indicators will even appear on your chart. So you always want criteria for everything you do. Otherwise, what happens is you're much more subjected to your emotions. And earlier on, it's so funny when people talk about me trading for 30 years because it's been a long time. And the reason I think I've been able to do this for so long is because I do have these criteria. Most of the tools that we're going to go over right now, I was using in my teens. So these have been a part of my life, almost like family. So let's talk about the Darvis first. I always like to give credit where credit is due. And Nicholas Darvis was actually a Hungarian dancer who became a stock trader when he was paid one time from a dancing gig in stocks, and I believe Canadian railway stocks. And he thought, what am I going to do with this? I rather would have had the cash to pay my rent, but he put the stocks in a drawer, and he happened upon them sometime later and realized that those stocks were much more valuable than the day they were given to him. The value of the stock had gone up. And I'm sure there was a lot more that went into it, but bottom line is he realized he had something more valuable than when he first had it, and he wanted to figure out how he could do this more often. And he became a part-time stock trader. And that really emphasizes the second thing. I trade approximately 3 hours per week. I'm not in front of this computer, this giant rig that I showed you. I'm in my gorgeous office reading some of the books that I have there that I showed you most of my day. I'm not recommending anybody just click away all day long. It's counterintuitive. Nicholas Darvis was a part-time trader who was able to, you might have seen his book, in the 60s, he was able to make $2 million. And believe me, back then that was quite a feat. It is a feat now, but it was especially a feat then. He traded only daily time frames. He looked at the charts after the close, and he was a part-time trader. And I think there's a lot to be learned as much from his habits as from his Darvis box. Now, what is a Darvis box? Once you put the Darvis on your screen, what you're going to see are these horizontal lines on the chart. And what they really are automated support and resistance. That's really what it is. Rather than having to take the time to draw all the lines and levels, automatically, based on a process of minor lows and minor highs and a particular candle count, and before you're thinking, oh my gosh, Raghee, do I need to know this? We've automated the process. That's why I love automated tools. It shortens the learning curve. It brings you something classic. I mean, think about this. This is a tool that's been time tested since the 1960s. So it brings you a classic tool that's been time tested, but completely automates it. And so that's why I love this tool. It automates support and resistance, because there's a tendency for traders to have a bias going into a trade, and they won't see the other side of the trade. They won't see the argument on the other side. So I want to see all the resistance and all the support. You know, what happens for long traders? They see all the support. What happens for short traders? Their minds just start to look for all the resistance. They try to find the justification for their opinion. Or as I believe author Moynihan and Paul from the book, What I Learned Losing $1 Million said, are you long because you're bullish, or are you bullish because you're long? A lot of traders start getting bullish because they're long, and it's a very dangerous trap. Automating your tools helps avert a lot of those types of those traps, okay? And again, because I start my day so early, you know, look, it's 4:30, sometimes maybe 5 if I sleep in. As much that can be automated before my coffee kicks in is very important, right? So we have our Darvis boxes automating support and resistance. I'm going to say something else, which is actually almost bordering on technical analysis heresy. I do not use trend lines. I haven't used trend lines in many, many years. I experimented with automating them. I didn't find they did what I wanted them to do, so I just abandoned them altogether. Trend lines are one of the most subjective things that you can put on your chart. Finding two arbitrary points. And maybe sometime in the future, I can walk you through what I was trying to do automating trend lines, because I know they're unbelievably popular, but there are 4 things that you have to automate trend lines. And automating it, getting the code down became really quite difficult. So for now, I usually tell most traders, just focus on the horizontal support and resistance. And if you want to look at more trending, or what's called them dynamic support and resistance, levels that are not horizontal or static, but rather they move at an angle, focus on moving averages, because those types of dynamic levels work best in a trend anyways, okay? So number 1, Darvis automates support and resistance, and you can get that active on your chart, 1 minute, 1 week, 1 day, doesn't matter the time frame. So how are we on that? Does that make sense, gang? Are we all right with that?
Yeah.
Yes.
Okay, excellent. All right, the next tool is called Simpler Propulsion. All right, so what do I do with this? One of the things early on in my career that I loved doing, and again, gang, what I'm hoping, and my sincerest apologies for anyone who's just logged in, we had some tech issues. The team here that you guys rely on, they're so great. And I'm hoping maybe in the future, once I can get the screen share problem figured out, I could walk you through some trades, which would be great. But getting the indicators set up now will be perfect, because you can play around with them, and sometime in the future, we can actually do some live analysis as well together, maybe even a small workshop or something. So what does propulsion do? One of the most common tools that I started getting into in the late 80s and early 90s was the popularity of moving average crosses, something elegant, something simple, and something that was, you know, really available to everybody. And moving average crosses, even now, continue to be something that people watch for. And they continue to be things that even people who are not traditional technicians, or people who don't even consider themselves chartists or technicians, they will focus on them as well. And that is just 2 moving averages crossing. If you've ever tried to use a moving average crossing system, you know the irritating, frustrating thing that happens. It crosses, it uncrosses, it crosses, it uncrosses. And for a brief amount of time, you don't even know if it's long, short, valid. It can be very messy. It's not a clean cross. So what we did is we realized that if we made the two moving averages cross, but then made them interact with support and resistance or recent highs and lows in a specific way, we reduced the number of these false starts, these false breakouts, these false signals. We reduced the number of them. We also found that when a short exponential moving average crosses a longer one, the ones that you're going to use in simple propulsion are some of my favorites. I like to use a 3 crossing the 8. And when you look at the indicator, you'll see it's already pre-programmed for you. You can change it if you'd like, but what you want to do is pick your favorite 2 exponential moving averages that will cross. Again, mine will be pre-programmed with the settings that I use, so you can at least start there if you'd like. And then what happens is when it interacts with price in a certain way, these dots appear. The dots will appear where the longer moving average would have been. So for example, a very popular cross for me is the 8 exponential moving average crossing with the 21, and that's pre-programmed for you. When the criteria is met, where the dots will be, number 1, they'll be green, and number 2, they'll be plotted where the 21 exponential moving average would have been. So I think of it as a self-correcting or smart exponential moving average. Remember, moving averages don't know what they are doing in sideways markets. They don't know what they're doing in a choppy market. In fact, we shouldn't even be looking at them for the most part in sideways markets. So these, when the market loses that organization of the trend, will typically just disappear. The other criteria is I would like to see usually at minimum 3 to 5 dots in a row. So that means I've given the moving average an opportunity to cross, interact with price, the criteria was valid, so the indicator is now visible, and then I want to see that it's steady. Okay, you've shown me you can meet the initial criteria, but let's see if we can keep that. So whatever your interval is, 1 minute, 5 minute, daily, you need 3 to 5 intervals of those dots appearing to say, yes, that 21 EMA or any of the indicator settings that are built into that up to 7 propulsion dot indicator that I just gave you all. You want at least 3 to 5 of them. So that validates that moving average. And then what do you do with it? Well, I can buy off that 21 exponential in the context of a trend. So far we've talked about automating support and resistance with a tool that's really been tested for almost 60 years. You know, we're talking about Darvis boxes even in 2020 because it's still, after all these years working, talk about time tested. I don't know how many of you have tools that have been valid for 60 years. If you're using Japanese candlestick formations, now you're talking hundreds and hundreds of years. But I like these old classic tools that it seems oftentimes traders just ignore or forget about in the pursuit of whatever is new and shiny. So Darvis, the next is moving averages. I think moving averages are pretty classic. I use the exponential, by the way, if you're curious. I use the exponential because it weights current prices heavier than the older prices. So whatever's happened more recently is going to have more bearing. I think it follows the natural recency bias that us traders tend to have. We have all these different cognitive biases, and most traders will give, just naturally as human beings, we will give more recent price action more weight. And the exponential moving average, in my mind, reflects that human tendency, that recency bias. So the last tool is probably, gosh, it's the one that I've developed early. It's my first tool that I developed as a young trader. And it's the staple of my trading. It's probably the most important, but it should not supplant anything you use now. You shouldn't have to stop doing anything you're doing now because of any of these tools. I don't ever want to change what you're doing. In my mind, I want to tweak them. I want to make them maybe more timely, more accurate. So the last tool is the grab and the wave. So is everyone doing okay so far?
Yeah.
All right. Any questions that have popped up as I've been rambling on here for a little bit?
We'll have a section for Q&A after we finish with the presentation.
Excellent. Okay. So the last tool that I wanted to share with you guys here is the most important. And so just like my love of sort of classic time-tested old things that still work well now, I'm a classic car enthusiast and collector, so I love things that have been working really well for a long time. I don't feel the need to always transition to the new. Things should be time tested. Be very discerning about what you put on your charts, including anything I'm sharing with you today. So the last thing is the grab and the wave. So grab is simply an acronym for green, red, and blue. Green, red, and blue. And you'll notice that the grab candles, once you activate them, they will color your candles green, red, or blue. So let's talk about the colors, what they mean, and what it does to the actual traditional Japanese candlestick. So what you have are dark green and light green candles. So that allows you to keep the traditional Japanese candlestick type approach, which means that if a candle closes up, an up close, which would typically be green or hollowed out in traditional Japanese candlesticks, this would be a light green color. Any light green shade, any light blue shade, any light red shade is going to be an up close. So all we're doing is keeping that traditional Japanese candlestick approach. A down close will be the darker shade. So if we close lower than we opened, it will be dark red, dark blue, or dark green. So that's the first thing. The second thing is that when we are looking at trends, most of the time traders will use either moving averages, going back to classic simple moving averages. A lot of times it's 20, 50, 200 if they're structured a certain way, or traders will wait for trend lines to be drawn to acknowledge that we have a trend. The problem with all that I found early in my career is they're too slow. They take too long to develop. And oftentimes in the patience of waiting for those moving averages to form in the right organization, or waiting for that touch point or two to develop so I can draw a trend line, I miss a lot of the good part of the trend, which is the early part. So what we have here is adherence to two things: knowing trending versus non-trending markets. And I know that might sound very rudimentary, but if there's anything that I have found after teaching traders for over 20 years, is one of the biggest mistakes that's made again and again, is that traders will persist in using a strategy that had worked very, very well, but they keep using it even after the market behaves in a new way. So, if you're an athlete and you're into sports and you're watching your favorite team, nothing is more frustrating than watching a certain pattern play out against your team and the team not make adjustments in order to stop that offense or in order to work around the defense of the other team, whatever it may be. To me, I love sports analogies, but we know there's certain things that happen that we have to adapt to. The markets are like that as well. So I'm trying to find, early in my career, I tried to find a way to see when those transitions occurred. Now, this too is something that is a very time-tested concept. Charles Dow, he did not coin the term Dow theory, but this is very much rooted in Dow theory, which is another amazing topic that would be great to talk about sometime in the future. Dow theory has a lot of different tenets, basically 6 main tenets, but one of them was understanding the underlying market phase or market cycle. You can use whatever terminology you'd like, but understanding the 4 distinct behaviors of the market. So here they are, by the way. Whether you know they're happening or not, they are affecting you. It's like weather. You can deny the rain is falling, or you can grab an umbrella. So there are 4 market behaviors that you as a trader on a 1-minute time frame or in a daily time frame are always going to have to deal with in every single market that you trade. And that is accumulation, which is a narrow sideways market; distribution, which is a choppy sideways market; markup, which is an uptrend; and markdown, which is a downtrend. So those are the 4: sideways narrow, wide choppy sideways, trending up, trending down. So you might think, okay, that sounds reasonable, Rag. I can see where, but the challenge is this: how quickly are you able to acknowledge that transition? How quickly are you able to acknowledge that the market's changing from one of those phases to the next? Here's where the grab candles come in. So big lead up to what these candles are saying. It's this simple. when you have approximately 5, I'll say 5 to 10 green grab candles in a row. It could be the dark shade, it could be the light shade. But when you have approximately 5 to 10 of them in a row, you have the beginning of a trend. So uptrend would be 5 to 10 green. Downtrend would be 5 to 10 red. Again, either shade, dark or light. And once the blue candles come in, dark blue or light blue, once the blue candles come in, that is like neutral market trend working its way into the psychology. It's not bullish, it's not bearish, it's hesitation, it's a pause, it's concern, it's just stopping the trend. So it's a neutral market sentiment. So when the blue comes in, you're losing the traction of the trend. You're losing that conviction, that organization. It doesn't mean the trend is broken. It simply means it's might be correcting, number one, or it might be slowing down. So pay attention to them. They're not going to have you change direction, but they should be a little bit of a warning. Sometimes 1 or 2 blue candles, for those of you that love to enter, as it's known, buy the dip in a trend, what would a buy the dip usually look like with my grab candles? They would be consistent green. They would be some dark green, maybe a blue. And usually that blue is going to be, one of the 2 blues are going to be a reason to get long. That will be how I get long very often. Now, that's not the only thing. I don't want you guys thinking, oh, just follow the green and blue and just buy and sell. No, but it is a visual cue. What else would I love to see? I'd love to see the propulsion dots, right? If the markets are truly trending, I should see these propulsion dots turn on and off. If you were to look at, I'm trying to think of a market that I was trading earlier, and not just earlier this morning, but just even earlier this week. If you look at the 1-hour chart of the Japanese yen, you can pull up the dollar yen and look at that. Now, I'm long this market as of this morning. I got long this market about, actually, I think I got long this market about 4 or 5 a.m. this morning. So if you look at a 1-hour chart, if you want to pull that up, and what you'll notice is since the 22nd, late around 7 p.m., I'm talking Eastern time, so sorry about any of the time adjustments, but 7 p.m. Eastern on the 22nd, I started thinking, all right, this is an uptrending market. I need to start buying the dips on the 1-hour dollar yen. The first dip that I bought was, again, I use limit orders. I like to use limit orders, so I know the value of where I'd like to be long. I bought the 105.03. I'll usually be a few pennies above a handle. I bought 105.03 on the 23rd around 6 a.m. It's one of the advantages of getting up so early. Then I did it again on the 24th. This time I had a Darvis level and I had the blue candle that was at about 3 a.m., I believe. That trade fired off. I was sleeping, but I had a limit order there. When I woke up about an hour and a half later, I was able to see I got my fill. And then today, around 2, 3 a.m., I got stuffed out. And I'm looking to get long again, potentially. So what you'll notice once you put all those indicators on the chart is that the second part of the grab indicator series is not just the color-coded candles, the green for bullish, the red for bearish, the blue for neutral, but also 3 moving averages. The 34 EMA on the high, 34 period exponential moving average on the high, the 34 period exponential moving average on the close, and the 34 period exponential moving average on the low. Now that automatically plots 3 moving averages on your chart. Again, these are those free indicators that I mentioned for TradingView that you can put on at your leisure. So if the candles are above the wave, that's what I call those 3 moving averages. The candles are above the wave, they're green. When they're inside those moving averages, they're blue. And where they're below those moving averages, they are red. Okay? So if you want to be a buyer, you really want to focus on mostly green candles. If you want to be a seller, you want to be a short seller, you want to focus on mostly red. And if you're thinking, I'm not really sure what this market's doing, I'm transitioning into that chop. If you look at that dollar yen, and these are some of the charts I wanted to share with you this morning. I like sharing things that either I'm in or that are very, very recent so you can follow along. So this is one of the charts that I wanted to share with you this morning. This is that dollar yen. And you'll notice that we went from pretty steady green, maybe one blue since the 22nd, one blue grab candle, one neutral amongst a sea of green. And then we went blue and then we went red. So the steady green went neutral and then it went bearish. That doesn't mean it's a short. It just means that the uptrend is broken. The mark up has turned into now a sideways chop. That's a really important distinction. So I was able to discern that on the 1 hour chart of the dollar yen at, well, my candles discerned that. I was still sleeping. At 2 a.m., we broke, I believe it was the stop loss I was looking at was about 105.30. We broke that support. My trade was over. But in the meanwhile, that was a trade that went for about, from top to bottom, I think I took, about 60 pip. No, went from 104. We bought at 105. Sorry, 105. We took profit at 105.50, so about 50 pips. And then I was looking to do it again. And that one stopped me out. So let's talk about stops for a moment, because I don't want you guys thinking all we do is win. The stop was really minimal. I took a trade at 105.40 and I got stopped at 105.30. So when you're using these grab candles and the wave to determine the trend and the validity of the trend, you're able to follow the trend for as long as it's valid, but it stops you out when the criteria is no longer met. I know we got a little bit in depth into the chart. I know it would have been easier to see it, but when you plot the indicators, and today, take a look at that 1 hour dollar yen chart and you'll see exactly the trade that I made. You'll see the blue grab candle. You'll see where the candles dipped into the wave. You'll see the candles dip into the wave a third time. So I had 2 winning trades within the context of this trend and 1 loser. And I really want to emphasize the loser, because if our losers are so big because the chasm between our entry and stop is large, it undoes all the good work that we did within the context of the trend. So take a look at that dollar yen. And, trying to think if there's any other notes that I would make about this particular trade for you all. That's really where I would recommend starting. If you want to understand my work, that's a really great current recent trade from this week. So is anyone totally lost? Any questions so far? Anything that you guys have for me so far? Is that?
Yeah, I have a follow-up question on stops and on stop losses. Maybe you can explain to the traders what limit orders are.
All right, so limit orders. What are limit orders? Terrific. So when we talk about order types, I was very lucky early on in my career to have a mentor who taught me about order entry. And so I'm so glad someone asked about orders. Stop orders and limit orders are what's known as a conditional order. That means that certain conditions have to be met, as opposed to a market order, where we'll differentiate what all 3 of these are. Market orders are get me in now, get me out now. So whatever price you're seeing on your bid ask, you know that that's approximately where you're going to get your fill. And so market orders, you're sort of left at the mercy of the speed of the market and the execution of your broker. So it's a little tricky. I'm not a big fan of market orders. I actually call them the order of panic. That means that if I'm actually personally going to be reduced to using a market order, that means something in my trading plan has gone horribly wrong. Horribly wrong. And another thing, sorry, I'm just kind of thinking of, and I'm sorry to ask you guys now, I probably should ask you via email, but I would love to share it with you all. I have a webinar that I did in Dallas. I visited my little sister, because this is a really good basic foundational question. And I would hate to lose you guys at a foundational level for some of these other concepts. Is there a way for me to send to you guys there a seminar that I did that you guys could send to your members?
Yeah.
Oh, okay. What I'll do is I'll send you all a link. I think it's on YouTube, but I'll see where we have it housed, and I'll send you all a link, because I did a webinar on TradingView for Awanda and another brokerage, Forest Park FX, and we did a 4 or 6 hour sort of all day webinar, seminar, both live and in person. And we have that recorded. And just based on that question, it just reminded me, yeah, some of you that are maybe still in the early stages of getting to know TradingView, and that might be really helpful. So I will definitely make sure you guys, let me write that down. I will send it.
Yeah.
It was a seminar I did in Dallas a few years ago, and I think it was specifically on Forex. And I think you guys will get a lot of benefit from it.
Yeah,
Okay.
we'll plug that in the show notes.
Fantastic. Yeah, I'll make sure it's available and you guys can watch that absolutely for free. So I'll send that to you guys. All right, so limit orders. So if we know a market order is get me in, out, just now, in or out now, it's the order of panic. I want you guys to think of it as that way. A limit order is I have a particular price level that I want to get in or get out at. But the reason it's called a limit is that because there is a limit. There's a price limit that you are designating to your order. In other words, you want to buy at, my limit order to get in on that dollar yen was 105.03, 105.03, limit order to buy. That means I'm communicating to my platform, to my broker, that I want to be a buyer, not only at that level, but I will accept a price no worse than 105.03. Condition, that's a conditional order. That's the condition of my order. Give me that order or don't fill me at all. So that's the limit order. Now, just to kind of round out our conversation on orders, the last is a stop order, right? People oftentimes associate stop orders with stop loss. Sorry, gang, the sun's rising here in Florida and it comes right through my office, which I love, but I get this weird lighting, so sorry about that. So a stop order is like a limit order. There's a condition, but what it is a market order with a price trigger. So it's a stop order is a market order that's waiting dormantly, but when a certain price criteria is met, that would be your stop price, it instantly becomes a market order. So I prefer my traders focusing on these conditional orders, which means that we had a trading plan, we had particular prices that we wanted to enter and exit at, stop losses and profit targets, and we have a particular price at which we want to do it. So I highly recommend conditional orders, especially for Forex traders and even now for futures traders, because the more the markets become this wonderful, nearly 24-hour type of adventure, almost 24 hours on futures, definitely 24 hours on Forex, these conditional orders are really important because there's no way that we could be up clicking the market order button, getting in and getting out. You know, that's what they call the Forex market, the insomniac's market. That is the limit order. It's a condition that has to be met before that buy or that sell is executed. Does that help?
Yes, it does. And Raghee, you mentioned that you've been trading traders for over 20 years now. So maybe in summary, you can tell us, given the uncertain nature of the markets, how would you define the attributes of a successful Forex trader?
So the transition of the markets, so the uncertainty usually comes when trending markets stop trending, right? So we can talk about uncertainty macroeconomically, but it doesn't matter. You know, we could go into a 1-hour discussion of macro and I would absolutely waste your time, because right now the central banks, which are the most important pillar of any macroeconomic study, and what's macroeconomics? Let's make it simple. What pertains to monetary policy for a country? What pertains to the money supply of the country? What pertains to their inflation and GDP plans, which come from the central bank? So growth, inflation, money supply, monetary policy. Those are your 4 macroeconomic principles. And they mean nothing right now because the central banks at the moment are basically doing their best. All central banks around the world are doing their best to basically undo these very natural business cycles, debt cycles, and macroeconomic cycles. So uncertainty can come macroeconomically, but it doesn't matter. So don't let that creep in. Uncertainty can also come from, you know, in the US, we have our elections coming. There can be uncertainty there. But I'll tell you what, letting politics seep into trading, always a big mistake. So I'm not even going to say that's uncertainty. If there's uncertainty in the market right now, It's stemming from the fact, and always remember this, it's stemming from the fact that right now, from an equity standpoint, and equities do affect currencies and currencies can affect equities, but right now, a lot of trends have stopped trending. So when you see consistent grab candles, as we've seen on the Australian dollar, for example, we've seen as the equity markets around the world have been taking off like a rocket ship, we've seen the Australian dollar and the New Zealand dollar participate. We've seen strength there. We've seen weakness in the yen pretty consistently. When the stock markets stop trending the way they are, what happens is we're going from that mark up to distribution. Uncertainty and oftentimes losses will always occur in distribution because traders are persisting and treating a choppy market like a trending one. You can avoid uncertainty. You don't have to be uncertain as a trader. I don't believe that's an inherent thing of having to be a trader, as long as you're adapting to what the charts are telling you. And again, 140-year-old Dow theory. Are you looking at the grab candle colors? That's how I've decoded Dow theory. And are we in a chop or are we in a trend? And chop broadly, I think, is where the uncertainty comes from. And we have to transition our trading to a non-trend following approach. No more buy the dips. Now it's going to be more about overbought, oversold. So one way to tackle the uncertainty, now that we know the problem is, let's talk about a solution. One way to tackle it is look at oscillators. Find the oscillators that you like, that you use, and identify overbought and oversold levels, and be realistic about the fact that the psychological uncertainty has played out in the price action, and that results in what Charles Dow would call distribution. So that's the way I look at what we're seeing broadly in the market, but I don't want people to feel helpless. I think there is a way to tackle it. We just have to change our strategy.
Right. So as we almost get the questions from the audience, maybe the last question would be, given your experience, would you stress the need to invest proactively in learning and guided mentorship like you had your own mentor, while seeking a solid foundation in Forex markets?
So I think when I started, look, I mean, I run a chat room and I do a lot of things, but this is what I would tell everybody. When I first started trading, there was no internet. I did my charts by hand, and most of my information came by in-person seminar and lots of books, lots of old books, because the cottage industry around trading only sprouted up recently. I would recommend in the very, very beginning, the best education that you're going to have is looking at the charts. It's for me, it's like learning a language. Yeah, I can read all the French books and I can start to memorize vocabulary, or Spanish. My husband and I are trying to learn Spanish. I speak Bangla at home with my mother, so I'm trying to become trilingual. I could try to flashcard myself to remember all the different Spanish words, or I could just move to Spain for a year and I'll be fluent probably within 90 to 100 days. So I think the brain requires immersion. I don't think immersion necessarily happens in a course or a book alone. I think that you take that course or book that you read and then you go right to the charts and you just immerse yourself into recognizing those patterns, training your eyes, firing and rewiring all those neurons in your brain until finally you're seeing those patterns. And that's probably what takes time. The best thing someone like myself can do is, I think, what we've started the conversation here today, which is how can I simplify and make the possible field of patterns fewer? So now you have a way to interpret the pattern of trending and non-trending markets. So rather than having to look at the markets for 10 years, now you can just take those 10 years and say, okay, now I know trending versus non-trending. And then the hard work begins. And that's going to be completely on the individual trader or investor. And that is, am I investing in a choppy market and am I using the right strategy? So that means on your time, you have to look at what are my trending indicators, my non-trending indicators, what are my choppy market strategies, and what are my trending strategies. So just like a good toolbox would be organized, you are now the architect, the mechanic of your trades, and you need to organize that toolbox. So once you know where all the tools are and what they do, you'll let things like the grab candles interpret the underlying market environment, and now you know what to apply.
Okay, I'm gonna take you back, Raghee, just a little bit regarding the strategy, the grab candle strategy. What would you say is the edge for that particular strategy, that particular tool? And what would you advise traders when they're starting out, beginners, newbies, when it comes to finding an edge?
Okay, so edge. I think the ultimate edge is what the grab candles provide, because we talked about uncertainty before, and the market's transitioning out of a trend into chop. Most market participants have no idea that's happening. Most market participants don't know that the trend is no longer the trend and is rather transition to distribution, where, for example, if you were using a moving average following type strategy, you would segue into something like an overbought or oversold slow stochastic strategy. So what the edge is being able to see the field, right? Most traders just apply the same strategy again and again and again, or they apply their favorite indicator again and again and again, regardless of the underlying market behavior. And maybe some of you can relate to this. They'll experience a 50% type success rate. Sometimes they're brilliant. Of course, it's the strategy working. And then they're doing the same thing and the market isn't responding the way it was. So then immediately they think, oh, my strategy's broken. And they discard something that was perfectly good. The indicator or the strategy didn't break, the market transitioned. So to me, the ultimate edge is knowing that certain strategies are applicable to certain market environments, and my job as a trader is to match them up. I play matchmaker with my strategies and indicators and the market. And the grab and the wave allow you to be a much better matchmaker of those things than most other market participants who are not acknowledging what Charles Dow taught us 140 years ago, that the market has 4 different market behaviors. And our job, first and foremost, is to recognize which one we are in.
Thank you. One of the questions that members, one of the guys sent was, do you normally consider the overall underlying bias, and which time frame do you use in order to consider the trending bias so that you can be able to execute trades using the grab candle methodology in the intraday or shorter time frames?
Okay, so the most powerful time frame, not the one that we always have to trade, but the most powerful time frame is always going to be the daily, because the daily reflects the broadest psychology. The daily reflects, I think, the most widely held, most committed psychology. So most of my opinions about the market, not the time frame I'm necessarily going to trade, but most of my opinions of the market are going to emanate from the daily time frame. So then the second thing becomes, well, which time frame would I trade? When it comes to Forex, because we're dealing with a truly 5.5 day, it's a true 24-hour market, I think that I can go out to a 60-minute, I can go out to a 240-minute time frame, which is not something I'll typically do in stocks and futures. In stocks and futures, I'm either day trading a 1-minute chart or I'm focused on trading the daily. So I'm very short-term, long-term, and that's it. Nothing intermediate. But in Forex, I can look at an intermediate time frame. So I'll look to sometimes day trade a Forex time frame as short as 5 or 15. If I see the structure of the market is clearly bullish or bearish, I'll maybe put on a trend following a day trade on a 5 or 15-minute time frame. What direction will I trade that in, right, was the question. I would prefer, even for my day trades, to occur when even the daily has nice green grab candles. So I want to see that my short, intermediate are matching up with a trend that I'm already seeing on the daily. That's my preference. Even when I'm day trading 1 minute, I would prefer to trade them in the direction of the overall market. And when the overall market is trending, the predictability and the probability of your trades, just your margin of error, is far better in trends. Everything that in your trading life is usually going to be better in a trend, unless you're one of those rare individuals that prefers to trade chop. But I find very few people actually do that. Most most traders do much better in trending markets. So start with the daily, try to find those trends in the daily, and then your intermediate and short term, trade them in the same direction as the daily, preferably. And then over time, you'll notice the patterns of reversals if you want to go counter trend. But I'm not really a big advocate of counter trend trading, if at all possible. I'd rather be on the side of sort of the path of least resistance. And that's where the margin of error for my entries, for my trades are best.
One of the members of the audience asked a question. Christopher basically asked, take us through how to improve on our entries, because the markets always go to the opposite side whenever I enter. Then which time frame do you recommend? I think Raghee has basically spoken about that in her previous response.
So, well, so I think just to address it very quickly, okay. Are we talking about a choppy market or trending? So now that you have some of these tools, are we talking about a choppy market or a trending market? And then here's the last thing. Don't buy at the top of a range. I'm not saying to short either, but most of my buys come at the bottom of a range. That could be the dip in a trend. That could be the oversold level in chop. So I buy at the bottom of the range. The range is defined by the underlying market, trending versus choppy. And I'll take profit at the top of the range. Or if I'm shorting, I want to be a short trader at the top of the range. So think about the timing of your entry. Are you getting long with momentum through resistance? Because now you're a little vulnerable to that momentum waning.
Okay, thank you for clarifying that, Raghee. So finally, I have to ask you this question. Obviously, guys will want to know which resources to access in order to be able to become better traders. So which trading books would you recommend? I would guess the first one right away, Nicholas Davos, obviously. You mentioned him. To novice and seasoned traders on futures and Forex trading.
So when I was showing you all the bookshelf that I have here in my office, I have very few trading books on that bookshelf, very few. So the Nicholas Darvas book is good. It's not going to teach you a lot about trading, but I find it probably a little bit more inspirational, because here's someone who was a part-time trader who had no real mentor, no classes, no seminars, nothing. And he still managed to do very well in the markets. And so I find that pretty inspirational, but he doesn't really teach you much about the Darvas approach, interestingly enough, in the book. But it is interesting and a very short read, so it is nice. Probably one of the books that I've had on my bookshelf the longest that I like a lot is a book called What I Learned Losing $1 Million. What I Learned Losing $1 Million. It's written by two authors, Brendan Moynihan and Paul. Moynihan and Paul are the two authors. And this book is very interesting because it talks about the very common traps that we fall into as investors and as traders in losing trades. What are the common traps? What's the common pattern that occurs? And if you can recognize the pattern, you can work your way through it quicker and realize your losses quicker and manage your money better. So What I Learned Losing $1 Million. Another book, I'm just looking at my bookshelf here. Another book that I would recommend for traders, if for those of you that want to be technicians and you want to study the different patterns of the market, the very best and the original book on technical analysis, on trend lines, patterns, etc., was written by Schabacher, and it's called Technical Analysis and Stock Market Trends. And I'm trying to find the book on my shelf, and I don't see it. It gets lent out quite frequently from the Raghee Library here. But yeah, Richard Schabacher. Technical Analysis and Stock Market Trends. Don't worry about the stock market thing. It applies to everything. So those are probably two of the books, and probably two books that most folks don't talk about. One's a book on the classic approach to technical analysis, and the other book is really a book about the mindset.
Thank you, Raghee. And before we conclude, there's just a tweet that you had put out there, and I would also want you to just expound on it more, especially it will be very important, I believe, to people who have been trading for quite a while. And the tweet is, life often dictates how we trade. It is not ideal, but a lot of times what is going around in life will dictate what I can do. So my natural instinct is in times of uncertainty. My natural instinct is in times of uncertainty, keep things a little closer to the vest. So your natural instinct and uncertainty, how does that help you basically navigate through risk?
So yeah, I remember that tweet. I think that was from an interview that I'd done. And so two things. We're traders, but we're also, mothers, fathers, daughters, sisters, wives, whatever. And so oftentimes when life is being life, I was just saying life is what happens when you're making other plans. Today, I'm going to trade and focus. And of course, 19 things are going to come bombard you. You can't be focused as much as you'd like. So that might mean an adjustment I'll make during a particularly hectic part of life is I might either shorten the time frames that I'm trading so I can be a day trader, trade for a couple hours and be done, or I will lengthen my time frame to a daily or weekly or something longer so that I don't have to monitor it as closely. So the easiest adjustment in difficult, distracting lifetimes is hold things closer to the vest. To me means I'll just shut it down sometimes. I'll just say, look, today's not the day that I'm going to make smart, wise trading decisions. There are plenty trading days every single year. Today is maybe not the best day for me to make those big decisions with my capital, and I'll shut it down. Other times I'll shorten the time frame so that if I know I'm going to have maybe 1 or 2 hours of sanity, I'll take advantage of that and make decisions that I know I may not be able to monitor as actively. So I can either shorten the time frame or really lengthen the time frame. So on a daily or even a 480-minute time frame, I don't have to monitor it as quickly. And inherent to a daily or 480-minute time frame or just a longer term time frame is the fact that I've already accepted some of the natural volatility of the market. There's a historical volatility every single Forex pair out there. There's a tendency of price movement. So even just by observing the market, that a daily time frame is going to present, maybe 100 or plus more pips in that session, while a 5-minute candle might be 15. So inherent to longer term time frames is this acceptance of a larger risk reward ratio. So I'll just adjust my time frame like a dial. I'll just turn it up or turn it down depending on what I need.
All right, Raghee, there's a question coming in from one of our participants. She's asking if you can please type in the author and the title of the book that you mentioned on what lessons I learned from losing $1 billion, and the other one from Nicholas Davers. And then as we wind up and conclude, maybe you can tell us, aside from the great lesson you've taught us from trading through on your grab indicator, where else can people go to find your analysis, your work? Do you post that actively on social media, and your contact details,
Sure. So I'm pretty active on social media. Sometimes I talk about a lot of non-trading things, but you can find me at Raghee Horner pretty much anywhere. Facebook at Raghee Horner, Instagram at Raghee Horner. My YouTube channel would probably be a really good one to visit. It's Raghee Horner on YouTube. So I think it's like YouTube/Raghee Horner, something like that. My YouTube channel has a lot of videos. So if you're looking for analysis and just different videos, just to start to understand what I do, that's a great place to start. My YouTube channel would be an excellent place to start. And then I'm going to talk to my office here and share that Dallas Forex seminar that I did, and we captured the screens and whatnot for that. And then I'll make sure I make that available to you guys as well. Those would be excellent places to start, and we'll give you a really good feel for what I do. As far as what I lost losing $1 million, I'm trying to see who the author is on that. I want to say it's Moynihan, and I'm actually typing this in. Moynihan and Paul, I believe is what that is. Yeah. And the Nicholas Darvis book, I think, is called How I Made $2 million in the Market, or something like that. But I wouldn't say the Nicholas Darvis book, if you want to check out, you might even find the PDF online on the internet. It's such an old book, you might find that. The Richard Schaubacher is the other one. Richard SCHABACKER, right? I'm typing that in, and that's called Technical Analysis. And I'm hoping you guys can see where I'm sending this. And Stock Market Profits. There we go. So those are the two books. But I'll tell you what, even if you don't feel like reading those two books, start off with my YouTube channel. There are hundreds of videos there, mostly on the Forex markets, but some on futures too. And there are some on topics like the wave and grab candles and so forth. There's plenty there to keep you all busy and probably borderline sick of me by the time you're done.
All right, so thank you, Raghee. Next time we will have you detail to us, your live chat analysis. Hopefully you will be able to share your screen. And then we'd obviously love to have you again in the future. And we do encourage guys to continue opening up trading accounts with Scope Markets Kenya. And we thank you for your time, Raghee. It's been a pleasure. And final words from my co-host, and then we can call it a webinar.
Personally, for me, it has been an honor because I started following your work 4 years ago. I think 5. So
wow. Well, let's keep in touch for sure. You have my email address. Everyone else, you have my YouTube. But yeah, let's definitely keep in touch. And yes, I would love to. Hopefully Zoom doesn't hate me. Again, for those of you that are participating, you guys are amazing. This is by far the most organized, amazing. And I would love to be back if you will have me. I would be honored to be back.
All right. Cheers. Have a good day. Enjoy your weekend.
Thank you. My day is just starting.
All right.
Thank you very much. Take care. Be well.
Thanks guys for tuning in and sticking with us to the end. We hope you have learned something new. I would like to appreciate Scope Markets for sponsoring this webinar. Remember, you can open a live trading account with Scope Markets and apply the lessons shared by the guest in this webinar to your trading. Many thanks to our guests for speaking to us. We'll be open to have you in the future. Till next time, goodbye.